special welcome to Matt Peterson, who I've worked with for years on just IRA clients and other tax and legal stuff. Matt's a CPA. We'll introduce him a little more, but he's also president of Dakota Reit, which we're trying to soak up some of his knowledge in the REIT industry and how it would apply to those with IRAs. So now, because we have Matt here and he is president of a REIT, they do let people invest in their stuff. And I want to let you know, I don't care whether you invest or not. I'm not saying whether to do it or not. That's up to you. We don't tell you what to invest in. These are self-directed accounts. And since I'm a lawyer too, I'm going to make sure we give a disclaimer. This is lawyer Matt. This is not fun Matt. This is lawyer Matt. He comes out once in a while and it comes up on this slide.
It's like comes out during Halloween.
Yeah, everybody's like, can lawyer Matt go away? We're having a fun Matt, Yeah. My kids, they remind me of that. So, but just keep in mind, this is meant to be educational in nature. We want to just give information about different things you can do with your retirement account, whether you do it or not. We don't care. I mean, that's whatever you want. So we just want to give you great education and bring in experts that can give insights. So nothing here may constitute an offer to sell or buy anything on Matt's part or ours, but hopefully you can get some good information about the REIT industry in general. You'll learn a little about Dakota Reit specifically as a case study. And then we'll hit some points on just IRAs, investing in privately traded REITs in general that I think will be important to know.
Absolutely.
All right. Well, many of you may know about me, of course. I'll just keep this brief. I wrote the Self-Directed IRA Handbook, the #1 book in the field on self-directed IRAs. I'm an attorney, as I said earlier, although I don't do that work much anymore. I spend my time running directed IRA here with my good man, Aaron Halderman. I write quite a bit for Entrepreneur Magazine. I've had over 10 articles, be #1 on the site, mostly on retirement or tax and legal topics. But generally, I'm just here doing self-directed IRAs. I self-direct my IRA myself. So not only do we, not only am I a customer, not only am I a president, I'm a customer.
That'd be the hair club for men.
Yeah.
and I missed that. I missed that one. I missed that one.
All right, Aaron's got his own slide now.
I did it. I did one.
All right, you can.
After months of Matt saying, "Well, I'm not doing one for you. You got to put it up there." So, I love what we do here at Directed IRA. I do a number of things. Mainly help people on board, get their accounts open, head up marketing, client services, our relationships that we work with. So work with Matt and Danelle over at Dakota Reit. I have over 15 plus years in the real estate space, so I understood what it is to be an investor that wants to self-direct prior to joining Directed IRA. So I would consider myself an expert in the note space and in lending and real estate. Matt would come and speak at my conferences, and we developed a friendship over the years. And then I joined Directed IRA in 2019, just a year after he founded the company. So it's awesome to be part of it. And we're just, got something that we're growing pretty proud of over here and just delivering a great customer experience. And so I think that's about it. I got 6 kids and, from Dallas, Texas originally, and went to ASU. So there you go.
Okay, also heck of a good guy. Likes to hold hands and take long walks on the beach.
Yeah.
All right, a little bit about Directed IRA. We're actually a trust company. Directed Trust Company is our official name. We operate under Directed IRA. That's important. Not every company that handles IRAs, particularly self-directed IRAs, is an actual trust company. What does that mean that you're a trust company? That means we're licensed. The banking department has had to approve us. We get examined by the banking department, who comes through and looks at all of our stuff to make sure we're not screwing up or stealing anyone's money. And we're audited by two different CPA firms on different things within our business. And so that's important for anybody that has money at a bank, credit union, or trust company. They all do what we're doing. They got examined by a bank department. They have to have regular audits too. So there's something called third-party administrators in our space that are not regulated or audited. They're just basically set up an LLC to state, and they have somebody that's a bank or trust company behind them. You don't know who they are, but they have control of your funds and your account. So just know that that's a little distinction about us. Okay, do you want to talk about any of these things here?
Well, really, we just put this up here is like there's lots of things that people don't realize that you can do with the self-directed IRA. We often refer to our space as investing in alternative investments, anything outside of stocks, bonds, and mutual funds. And so, you can invest in Bitcoin and crypto, private companies. You can do, notes or private lending. You invest in private companies. You can do a checkbook IRA LLC structure. I have a crypto Roth here, so I'm also not only a work here, but also a client to direct it. And so, you know, done well with that. We saw Bitcoin rise up crazy the past 24 hours, really. So we got a lot of cool things that we do here, and there's a lot of cool investments you can make in self-direct.
Yeah, so do what you want to do, you know,
Yeah.
I mean, that's the point of self-directing. So we do all the different account types from traditional and Roth, solo Ks, covered Ls, HSAs. You can self-direct all these accounts.
That's important to know.
Yeah. Okay, this is Matt Peterson. We'll just intro him. We'll give you the format to just talk about REITs, and I've got some of your slides here. You probably, I mean, geez, I don't know if you know what ones we cut and didn't make the show or not, but you just have to wing it.
We left the best hits. Don't worry, we left the best hits.
Yeah. So Matt, why don't you just come on, tell us about yourself and Dakota Reit, and then we can just jump into some of your first slides here. I'll stay ahead of you. How's that?
Sounds good. Well, thanks, Matt and Aaron. Really appreciate the opportunity to be here. My name is Matt Peterson. As you said earlier, I'm the president of Dakota Reit. My background, I'm a CPA. I've been a CPA for 25 years. I've been a real estate investor since 2008. Part of my career, spent 16 years at Microsoft, primarily in mergers and acquisitions and helping our leaders enable strategy. I left Microsoft in 2015, and at that time I joined the board of Dakota Reit, and a couple of years thereafter was tapped by our president at the time to be his successor, and that's been a 3-year process, been an awesome experience. So effective this June, was elected president at our annual shareholder meeting.
Congratulations.
Thank you. Thank you.
All right, cool.
The REIT itself, we are 23 years old. We have approximately 75 properties in the upper Midwest. These statistics are as of the end of 2020 in our audited financials. So at the end of 2020, we had approximately 600 million of assets under management. And over that 23-year history have delivered an 11.74% compounded annual return, assuming you reinvested your dividends. We have paid a greater than 5% dividend over our 23-year history that is paid out quarterly. And we have approximately 1,100 shareholders. Our portfolio is a diversified portfolio that we'll talk about later in the discussion, but that is a mix of about 4,000 apartment units and 2.5 million square feet of commercial space. In terms of our investment philosophy, if you'd like me to keep going, I'm happy to do so.
Yeah, we'll interject here after this one because I have a couple questions coming on. So
okay, in terms of our investment philosophy, we seek out property that we consider to be institutional grade. They're stabilized, they're producing a solid cash on cash return. In today's interest rate environment, we are targeting a 7% cash on cash return, and as an initial target and grow from there. That permits us to pay that above average distribution yield when compared to publicly traded REITs. And we look to acquire our properties at cap rates that are a healthy spread over the long-term interest rate in which we finance it at. So spreads of 2 to 3% cap rate over the mortgage interest rate. And we do focus today on multifamily institution or multifamily industrial and some grocery anchored assets that would be in great neighborhoods.
okay, what's the difference between a privately traded REIT or and a publicly traded REIT? Like some people may have bought a publicly traded REIT before, but I think there's more of those. What's the differences? Someone should know.
Yeah, I guess how I would kind of start by answering this is that I look at investing in a private REIT is kind of more akin to acquiring a piece of real estate. It's something that you typically would hold long term. You don't have to. It just seems that a lot of our shareholders hold our stock long term, so they're not buying and selling like they might with publicly traded stock. And so then with those long-term investors, that we have a stable capital base that permits us to, have a liquidity redemption program for folks when they want it and pay this above average distribution yield. Really the main difference is just the very low correlation to equities. Our share price is very stable, and our shareholders can receive the appreciation in the share price over time. The share price is based on the performance of the underlying portfolio and not any sort of market hype or euphoria around it.
Okay, there was a question that flew in when you were talking there. So is there much of a secondary market for privately traded REITs? People ever sell on a secondary market? I know you mentioned you have like a redemption program, but where people can basically sell back to Dakota Reit, it's not like immediate, I'm sure, but is there a secondary market?
Right. Yep. There is, but it's not huge. So the secondary market, there are transactions that take place between private parties. There are broker dealers that can serve as an intermediary in the secondary market. There certainly are transactions that occur each year. I wouldn't say it's common, but it is done. In our redemption program, we're proud to say that we've never said no to a redemption request. And we really are more like a mutual fund. So when you sell your shares in a mutual fund, it's the mutual fund that's buying the shares back from you. You're not selling it on a secondary market. But yes, there is a secondary market, it's just not that common.
Okay. So let's say I want to use my IRA to invest in Dakota Reit, and I'm like, I want to be in it for 10 years. I don't want to be in it forever, but I'm not buying it to get out next year. I'm like, I'm going for a longer term horizon here. My way out at the end of 10 years, I've hopefully got some cash flow from it. Maybe there's some distributions. But at the end of 10 years, I'm hoping there's some appreciation on it too. I would go back to Dakota Reit and say, all right, my 10-year window is up, or whatever it is in my mind. I'm going to go buy a beach house or whatever. I'm going to go buy a bunch of Bitcoin. I don't know, whatever someone's doing. What's that process is the redemption program. Like that's how you get your value back.
That's correct. Yep.
As opposed to just selling on a market.
Yep, that's correct. So there's a quarterly process where you submit your requests to us. Our board reviews them quarterly. And there's a quasi budget established per quarter that the board can adjust. The budget going in is 100% of the share sales that occurred that quarter can be applied to redemptions, and 50% of the value of the dividends that were reinvested that we didn't pay out in cash can be applied to redemptions. It's been sufficient to cover the redemption request to date. But if there was one that came in that caused it to exceed that budget, the board has the ability to do so.
Okay.
Well, I like the inflationary question.
Yeah, go ahead.
Yeah. So anonymous attendee would like to know, how will an inflationary economy impact private REITs?
Real estate in general, private REITs, no exception. That they can be a hedge against inflation for sure. Today, a little over 50% of our portfolio is multifamily. So those are annual leases that have an ability to be adjusted for inflation on an annual basis. And most of our commercial leases, we have approximately 350 commercial tenants. And nearly all of those have escalators in their lease agreements. So the ability for us to adjust our rents based on inflation, we have quite a bit of agility with that.
That's awesome.
Cool. All right. Well, I know I have some numbers here. You guys have a lot of IRAs invested here. I don't know if you want to run through your numbers on IRAs in Dakota Reit. It helps other people who may have already done it in an IRA that are in your fund and know other people did it in their IRA, or some other people may be thinking about doing it.
So today, right, we've got close to 200 IRA investors. They represent about 9% of our outstanding shares, about 27 million. We have close to 300 million of value in outstanding stock right now.
Okay, that's awesome. Now to be a REIT, I think just so everybody may know, if you're like, hey, I raise capital for real estate deals, and maybe I've done a private fund before, or a Reg D offering to raise money in real estate. That's certainly common and you can do, but a REIT takes a little more because you have to have how many investors? You have to have 100 investors.
You have to have, yep, this is one of the tricks. I mean, this is kind of what prevents a lot of real estate investors with big portfolios kind of prevents them from going out and becoming a REIT. Because you need to have within your first year of formation, you need to have 100 shareholders. But the bigger thing why it's hard for large real estate investors to become REITs is that you also can't have more than 5 people own more than 50% of the REIT. And so we, as a trust, we've limited it to, and most REITs do this, no single person can own more than 10% of the REIT.
Yeah. Okay. All right. So, and then you also, as a part of being a REIT too, I just want to distinguish this from other funds that might be out there, or let's say maybe invest your IRA in a Reg D fund or something. The REIT also has to commit to distributing a certain amount of revenue, right? Or of the net income, I should say. What's that rule on that? There's a requirement on that.
Yep. The specific rule is, so the REIT gets to deduct as a business expense the dividends we pay out. And in order to be able to deduct that, we have to pay out at least 90% of our taxable income in the form of dividends. If we only paid out 90, that remaining 10% permits us to still be a REIT, but the REIT would pay corporate income tax. So we always pay out 100% or greater of our taxable income. So all of the tax liability is passed through, just like a partnership or an S corp is passed through to our shareholders. And really, the REITs were formed. Its original intent was to enable more average investors like us on this call to have access to high quality real estate. And REITs are, Matt's referencing them, they're really just kind of a compilation of a bunch of tax code.
Yeah. Yeah, that's a good way to put it. All right, so I've got some appreciation. Hopefully I'm going to get in the long haul. Just thinking of my 10-year example, you guys actually have to pay out distributions of net income. Now for an IRA, I just want to make an important point here. We're going to get some points on IRAs because Matt, you mentioned, let's say you're an individual, that the REIT doesn't pay tax if it's following the rules right. It's pushing its tax liability down to the owners. Well, if I'm an IRA and I own the REIT, cool, I don't pay any tax when I get that income. It's a dividend. And even if the deal is leveraged with debt, sometimes you might have UDFI or UBTI in an IRA and some real estate funds. In a REIT, you're exempt from that. And so REITs are really clean for an IRA from like any of the tax or UBIT rules, is that I don't have to worry about that.
That's a huge benefit.
Yeah, even if you are leveraged, Matt, because we had a question pop up. Someone just asked, basically, I forgot whose name it was, but someone asked, how do you guys use leverage, and what's the typical leverage you have on your properties?
Yep. Everything you said is exactly correct, Matt. And then in terms of leverage, we do start as a portfolio, we're 61% leveraged. We normally start an acquisition at 75% at the time we acquire it. But we as a portfolio are 61% leveraged currently.
Okay. All right, great. Cool. Okay, here's some of the numbers you guys saw there. Average investment, 139,000. Is there a minimum investment amount in your REIT or in REITs in general? Like, do you usually have to have like 50 grand, or is there 100 grand, or is that common?
There are minimums, and that is common. We have 3 different forms of share class, 3 different common stock classes. Class B are non-voting shares, and that's a minimum of 25 grand. Class A, our voting shares, that's a minimum of 50,000. And then we have our institutional shares, which is just a fancy word for a bigger investor. You don't have to be an institution. And that has a minimum of 250,000.
Okay. I saw that your average IRA investment holding, so if like I'm come in as an IRA investor, you have that 139, about 139,000 is what your IRA investors come in with typically.
Yep, that's our average. And across our 1,100 shareholders, the average is closer to 260 grand or something like that.
Okay.
Okay, cool.
Great.
All right. Now a privately traded REIT, like you're going to need a self-directed IRA, right? Because, you know, if someone's IRA is at Fidelity, let's say, they're not going to be able to invest in Dakota REIT. There might be some publicly traded REITs they could do, but any privately traded REITs, right? They're not, these IRA holders are self-directed, right?
That's correct. All of them are self-directed.
Okay.
And some of them are your clients.
Yeah, I know. Which we love. Yeah, it's a win-win, right? Okay, you tell me, Matt, what other slides you want to hit on here. If you're like, nah, skip that one, or if you like this one, I kind of think this one's interesting. When you sent this over, I was like, because I'm always comparing to the S&P 500, right?
Mm-hmm.
I mean, I know even like in, you know, what's his name? Tony Robbins, but you know, his book on, was it Financial Freedom? No, what's his book? His last financial book, where he basically went into Wall Street and it's like none of the money, hardly any money managers can even beat the S&P 500. And he talks about how Warren Buffett, you know, bet, you know, all hedge fund managers, if they can beat the S&P 500 over a 10-year window, net of their fees, he would donate $1 million to charity of their choice. And he won that bet.
Yeah, no one did it.
No, people did it, and he won.
Yeah.
And so, yeah, no one beat it. No
Yeah.
one beat it. Yeah. So there's always been this, for me, there's always been this marker, you know, if I'm going to invest in the market, or, you know, can we beat the S&P 500? So why don't you walk us through this? You have some numbers on this, on the S&P 500 compared to some other stuff.
Yeah. So in this slide, and these are as of 12/31/20, we're stating that had you invested 100 grand 23 years ago, and all these numbers are assuming you reinvested your dividends with us or you reinvested them in these indexes,
Okay.
that we would have generated a return multiple of 12.84, meaning that your 100,000 is now worth 1,284,000 at the end of 2020. It's worth more than that today. That is almost double what a common benchmark for the REIT industry, the FTSE Nareit index, they would only be worth 670 grand, and the S&P 500 coming in slightly below 600 grand over that exact same investment time period.
That's a cool.
And this is really because, I mean, a lot of it has to do with being a private REIT and the performance of the portfolio as the driver of the share price.
Yeah.
Love it.
Awesome. Okay. I think you talked about some of this, but I don't know if you want to get into the tenant mix. You have some commercial property, a lot of multifamily too.
All we're sharing there is that not only are we diversified by asset type in terms of multifamily and industrial, grocery, a little bit of 15% office, 18% retail, but then within those 350 commercial tenants that make up about half of our portfolio, they are too diversified by industry type, and this diversification is important to us because each asset type performs a little differently based on what phase you are in an economic cycle. And it just allows us to be much more consistent and predictable in our performance, in our ability to insulate our shareholders from cycles.
Okay. Love that. Okay. All right. Benefits of investing in a REIT. I think, yeah, go ahead.
Yeah, let me interject something on that, going back to that slide right there on the diversification. So, you know, a lot of people some of the questions that were coming in, a little bit you addressed, like, you know, how does this affect tenants, you know, who withheld rent due to COVID-19? You know, what did you experience as a company? And then, you know, when we went through the last recession that we had hit in 08 and 09, there was a big mess and, you know, potential negative returns. Like, what kind of effect did that have on you as a company, and what changes or pivots did you have to make to potentially recover from that? I'd like that discussion.
Definitely. I'll start with 08 and 09. So
Great.
we started as a North Dakota REIT, and we were still in 08 and 09 in North Dakota. During 08 and 09, North Dakota was in an economic boom. And the big drivers of our economy are agriculture and oil. We didn't experience any of that. So 08 and 09 was a non-event for us, luckily. Now we've diversified outside of North Dakota and have invested in, you know, Omaha, Des Moines, Sioux Falls, the Minneapolis metro. And when we get to COVID-19, I have our Chief Operating Officer and Executive Vice President on this call as well, Danelle Jung. Within her team, they were able to navigate that extremely well. Multifamily actually performed a little better than normal. And, you know, as you know, a lot of folks migrated to the Midwest during COVID. So that actually helped occupancy. And then on the commercial side, we had braced for something much bigger than what occurred. And so of those 350 commercial tenants, only 40 of them, it worked out to about 12% or so, asked to enter into some sort of adjustment on their lease. Let's abate rent, let's defer rent. Everyone's current on those agreements. Most of them have been paid back. And so we deferred or abated 1% of our revenues, and we lost another 1% due to bankruptcy. When it comes to a popular benchmark to measure REITs, funds from operations, our funds from operations in 2020 was only down a couple $100,000, 1.5%. And now in 2021, nearly all of our spaces that were occupied by tenants that went bankrupt, nearly all of them are released. We've had tremendous leasing activity in our retail spaces. We've come out of it so far really well.
Great.
Yeah, that's good. That was a great question. We're getting good questions.
I know these are
Okay.
a little bit better. We usually get good questions, but these are some good ones.
Yeah. All right. Why don't you walk through like real estate? You have the slide here on different benefits, why to invest in real estate. And then I got some of the REITs and tax efficiency to shareholders coming up.
Okay, yeah. Well, so one of the questions that we've received from the audience, our participants already, already discussed one of the benefits, which is the potential hedge against inflation.
Yeah.
The others are around, they're really core to our investment philosophy, and they're one of the benefits that flow through to our shareholders, where you're going to be able to have an attractive and stable income stream investing in a private REIT. And you're going to get that appreciation in the value of your shares over the long term. And then you're also going to get the benefit of diversification. You're going to diversify your portfolio by investing in a private REIT. You're going to have that low correlation to public equities. That's part of the diversification story. The other part, of course, is the types of properties that we or another private REIT might invest in and where they're located. So if you were looking at, investing in real estate yourself directly versus through a REIT, that diversification you can receive through a REIT can be a stabilizing influence.
Okay.
I think we had something on depreciation, like any kind of depreciation that we can expect. Peter asked that.
Yes, so right, this slide, it speaks to that as well. The dividends that are paid out by a REIT are favored in tax code. So they receive special treatment. And how that happens is through depreciation. As Matt said, we are able to pass through, just like a K1 from a real estate partnership you're invested in, we're able to pass through on your 1099 from Dakota REIT, your pro rata share of the depreciation. We've averaged.
Now, this is if you're an individual, right? This is if you're an individual, right? If your IRA's in here, it doesn't matter because your IRA doesn't get depreciation, it doesn't pay tax either. So what are you going to use depreciation against? You don't pay any tax. But let's say this just make a distinction. You're talking individual right now.
Fair point. Yes. So we have averaged over the last 10 years approximately 50% taxable. So that means if you get $10,000 of dividends from us, you're only going to be taxed in the current year on $5,000 because half of that went to depreciation pass through. The other favorable treatment is what occurred in the 2017 Tax Cut and Jobs Act. A lot of you are probably aware of the 20% pass-through deduction that you receive as an owner or partner in a partnership or an S corp. That 20% pass-through deduction also applies to your dividends. So then now you're paying tax on 80% of the approximately 50% after the depreciation pass-through.
That's awesome.
So that makes the after-tax yield that much higher, and your effective tax rates could be, in the 15% range, even at the highest tax bracket as ordinary income. If you're in the 37, 39% bracket, your effective federal tax rate is going to be somewhere in the 13 to 15% range.
Yeah. I think the REIT structure is one that, man, whatever tax lobbyists they have in DC, like we all need to hire them. Oh my gosh. Like they have really engineered a lot of great tax treatment and a lot of like negative effects you get, maybe that in some other investments, it's like they've just like paved the way and like, oh, UDFI or UBIT, nah, you don't have it. There's a revenue ruling on it. You don't get it. You don't have to worry about it.
They're like, what else can we do for the private REITs?
Yeah, like I get dividend income and I get to take depreciation against it, and I get the 199A deduction on it on top of that, which was meant for small business, but REITs were able to qualify for, which is cool. So, I don't know who the lobbyists are in that industry, but they're doing a bang up job.
Matt, when you go through, I think we get a bunch of questions coming in on this, and it'd be good just to talk through it one more time, just a little bit more clarity. So we went through the different classes typically of shares that you see in a REIT. Like you have 3 different classes: a 25K, a 50K, a 250K as the minimums there. But like, what are typically the lockup periods? Like, what kind of liquidity provisions are in place? How do I redeem prior to the lockup period? Like, give us some everybody listening some context into that, what people can expect.
Sure. So from per SEC and us just being a Reg D offering, you're required to hold the shares for 1 year, and that's it. We don't have any lockup period, but we have a suggested investment horizon of 10 years, and we have a redemption program around that where your most favorable exit from us would be at the 10-year mark, where we do have a redemption fee, and that varies by share class. But if you've held the shares for 5 years, it drops down to a 5% redemption fee. If you've held the shares for 10 years and you came in at the class I level at 250, the redemption fee would drop down to a processing fee of $3,000 or 5%, whichever's less.
Great info. A lot of stuff I didn't know, actually. Like, I know a lot of the basics, but very good. Cool. We had a ton of questions come in on that. So I think that's important. That's one of the things like why people like to self-direct, because they want to take control. They need deal flow and great companies, to invest in, like yours. But they're like, also want to know, okay, well, how can I get those funds back if I want to do something else, or if I have some sort of life event that happens too.
Yeah.
So cool.
Let's go over this
This is
UPREIT
good.
example here. I don't think a lot of people know about this. We can talk about the 1031 exchange. I think it's interesting on how that can be used. And then we're going to come back to IRAs. I got some summary points on IRAs that we want to make, but let's go, because the 1031 exchange, this UPREIT's not going to apply to an IRA, but like another
Right.
an outside investor that's just buying and selling, let's say real estate, in their personal name or in their own company that they own, they're going to have to deal with these taxable gain issues. So why don't you explain this UPREIT and who should maybe be looking out for this and how it could be beneficial?
Yeah, so the UPREIT process, we have approximately 200 of our 1,100 shareholders that have done this.
Okay.
And so like, for example, just
Wow.
this year, we've brought in 15 million of tax deferred exchange money. And why people are doing this is, one, for the tax advantages. So, just like a normal 1031, you would get to defer your capital gains tax. But the other benefits are, with doing it with a REIT, then you're moving out of active property management and you're moving into a passive role. And then you're getting that added diversification. Instead of you owning 1 or 2 properties you just sold, now you're going to own a portion of 75 across multiple cities. And so there's those advantages. Of course, then there's the estate planning. A lot of people do this for estate planning. It's easier to split shares with your heirs than it is to split real estate. And that's another driver, as well as just reducing your risk. Owning real estate directly and having a mortgage and that recourse debt, you're not responsible for any of that as a limited partner. So how this mechanically works, then, if someone were wanting to do this with Dakota REIT, we do have a minimum of $500,000 of equity to do an UPREIT transaction, and it can occur in 2 ways. One, you have a property that we want and we agree on a value, and you contribute that property to us, and that's called a traditional section 721 UPREIT transaction.
Okay.
The way that it can also happen, and is quite common, is it's a 2-step process where you sell your property to someone else. You use a 1031 intermediary, and we work with you to accomplish your 1031 exchange. You're going to buy a piece of a property. You're going to buy a tenant in common interest in a piece of property that we're going to buy alongside you. And you're going to accomplish your 1031 exchange just like you normally would. You have 45 days to identify that property, and you have 6 months from the day of your closing to buy that piece of property with us. And then as a subsequent decision down after you do your 1031, you then decide to contribute your TIC interest to us. So then we own 100% of the property. And in exchange, we give you limited partnership units where now you participate in the economic performance of the whole portfolio.
Okay.
All right.
All right. So basically for someone that has a highly appreciated property that they're going to have more than $500,000 of gain, they want to stay in real estate, but they don't have they're like, hey, maybe I'm stuck. They have 2 options with you guys. If it's a property you may want, they can contribute it. And let's say that they bought that property for 200 grand years ago, and now it's worth $1 million. They have an $800,000 gain. They don't want to pay tax on that. They don't have a property they want to replace it with. They can come contribute that to you at the $1 million value. You give them $1 million worth of shares essentially in Dakota REIT. They don't
Assuming they have no debt.
Okay. Yeah. Okay. Good. Yeah. Because you net it out, I guess, if there was
Yep.
debt or something. Okay. Let's say they had no debt. Keep it simple.
Yeah.
And then, but you give them the value essentially in shares in Dakota REIT. Now that assumes it's a property you guys actually want.
Yep.
Or if it's like, nah, it's not a property we want, then you could say, go ahead and sell it. And I'm just restating it here to make sure I understand it, because this is new for me. I mean, this is new for me. I've never heard this before. So I could instead And I love all these strategies, by the way. So my brain's like, ooh, this is cool. Um, so you could say, well, we don't want that. I'm like, all right, I got someone who'll buy it for $1 million. I'm going to get that $1 million of gain. I'm going to use a 1031 exchange accommodator. And then hopefully you're always buying properties, maybe, and you're like, hey, we've got one on the horizon. You're like, great, you can come in here and get a tenant in common interest for that $1 million. You're buying essentially alongside us. And then how does that work though? Like once I close, let's say we've closed on that. Am I still in tenant in common? How do I get into the REIT? Do I become a shareholder in the REIT? How does that work?
Yep. So once you complete the purchase of the tenant in common interest, you've accomplished your tax deferred exchange. You've deferred your gain.
Okay.
Then you're going to want to work with your tax advisor to make sure that they're comfortable with the length of time period that you hold that TIC interest. Some CPAs are fine with it being a simultaneous transaction. Others want you to hold it for a period of time. Our specific tax advisors are comfortable with them holding that TIC interest for a shorter period, and then contribute it to the REITs and then receive the dividends and performance of the whole portfolio.
Okay. All right. So there might be a little bit of time window, but eventually it gets that tenant common interest gets contributed. Now the REIT owns that TIC interest. I've exchanged it for shares and now I'm in the REIT. I effectively deferred all my gains. That becomes part of my new basis and my shares in Dakota Reit.
That's correct, Matt. You're right. Your basis carries forward. So your basis you have in your property that you relinquished or sold is your basis in your stock. And so maybe I'd make a couple extra points here. One, so you get to take your tax liability that you aren't responsible, you're not paying right now, you're deferring it. You get to take that and buy shares, buy limited partnership units in Dakota Reit. So you just increased your wealth.
Right.
You're gonna get dividends on those additional shares that you should have paid to Uncle Sam in a tax liability. So that's all awesome.
Yeah.
And
let me just pause there for a second. Let's just go through the numbers here. Let's say it was that example I gave. I bought for 200, it's worth $1 million. I'm gonna have an $800,000 taxable gain, right? Let's say you're gonna be in a 20% capital gain bracket there because you got enough revenue, just on the gain right there.
Mm-hmm.
Let's say you're in a state with 5% state tax. Let's say you're lucky you're not in California, okay? You're 5, so you got 25% on 800 grand. That takes you down $200,000 of tax extent. So at the end of the day, I would have only been able to reinvest 800,000 instead of $1 million total. So now I got $1 million worth of shares in the REIT and $1 million working for me as opposed to 800 grand. I mean,
that's a beautiful thing.
Over a 10-year investment horizon, if I'm holding this for another 10 years, that's significant.
And that's a good transition to the other comment I was going to make. So while you can sell your UPREIT units, and so your stock in Dakota Reit after you've done an UPREIT with us, and some people do, but when you start to sell it, then you trigger your capital gain. So like if you sold half your shares, you triggered half of your deferred capital gain. Okay. So some people do sell their shares, because then if you do sell, it's kind of like you sort of have like an installment sale on your original sale, because you're just going to recognize a proportion of your deferred capital gains, and that's fine.
Makes sense.
But what a lot of people do is they do hold their shares until death, assuming current tax code stays the same and you get your stepped up basis, and then you truly have forever eliminated your deferred gain.
Okay. All right. Okay, cool. That was a little deviation from the IRA stuff, but that's a cool strategy. I think a lot of our self-directed IRA clients do real estate themselves. And so on these UPREITs though, let me just just because I think this is actually pretty interesting for our listener base for their stuff outside their IRA. You said they need to be a 500,000 gain or more to make it worth it, essentially, or to look at it. But are you looking for let's say someone's going to do a single family, they got a single family rental or a fourplex. Like, is that stuff you're going to pick up, or is that stuff you're going to say, nah, sell that, and then let's work this TIC? What do you call that process? Not the 721.
Get kind of the two-step process is 1031 followed by 721 UPREIT. Yep.
Okay.
So we are for us, you're right, Matt. Good clarifying point. We wouldn't want, single family homes or duplexes, or even small multifamily. We would stick to our investment philosophy of kind of institutional grade, larger complexes or building, and in the markets that we invest in.
That makes
So
sense.
yeah.
Okay. All right. Okay, cool. All right. I just want to make a couple notes. I think we hit most of these. So I noted this earlier, just for IRAs investing in REITs, which include private REITs. There's no UBIT, no UDFI. Your income is dividend income. And so dividend income is always exempt from this. And like Matt said earlier, like individuals, you actually get a 1099 div. You're not getting a K1, right? Like Matt mentioned too, Dakota Reit, for example, has a 10-year horizon. I think that's probably most REITs, right? They want you to have a long-term horizon, at least on the privately traded side. Otherwise, you're going to have fees to get out earlier, sounds like. There are minimum investment amounts. I forgot what you said yours was. Did you mention that? I just joked.
25, 50.
Oh, that's right,
250.
25. Okay.
Yeah, 3 class shares.
For non-voting. Now, what about accredited investor or not? Does it matter whether someone's accredited or not for public REITs versus privately traded REITs? Help us understand.
That's something that should be clarified too. So we do a Reg D 506B. So we are able to bring in some unaccredited investors. That we have as a private REIT. This isn't specific to a REIT. This is just being a private company that is not publicly traded and not yet registered with the SEC. We can have up to 500 unaccredited investors. If we exceed that mark, then we have to become a public reporting company, non-traded. So we'll probably get to that level, not maybe not due to the number of unaccredited investors, but due to the number of shareholders. That's also a threshold that the SEC has, where if you exceed 2,000 shareholders, then you would need to become a public reporting company, which means basically you've got all the responsibilities of being public, but you're still in control of your share price.
Which is nice. Okay.
Okay. All right.
We should probably go over, you want to go over some of the, what do we have here next on the Dakota REIT value proposition? And then,
I don't know, what else, anything else you want to talk about, Matt? We got about 5 minutes left here. Let me know if there's a slide you love that we didn't hit, or anything you just want to.
Yeah, I think I would just close out maybe by just speaking to kind of why invest in Dakota REIT and what, our core philosophy and principles. We're 23 years old, and these kind of just.
You guys are old enough to like be graduated from college. I mean, it's just like, that's pretty good.
So these are kind of the core, just kind of our core tenets that have defined us. One, that we consider ourselves a long-term investor. So while we will sell property, it's our intent to hold it long-term and be patient. We'll ride out the economic cycles. We'll ride out the real estate cycles. Because of our diversification, we're able to sort of insulate our shareholders from a bumpy ride. And we know that these cycles are going to occur, but they're also short term. And so we keep that in mind as we look at our share value. We're going to continue to be a diversified REIT to give us that added stability. And we purchase properties at cap rates that meet our objective to pay an attractive dividend yield. So we're not following the euphoria of some of these cap rates down to, sub 4 cap rates. That does not work for us. And that's why, in the multifamily space specifically, we have forged some development alliances where we can develop multifamily, let the developer take most of that risk up front, but will be an exit strategy for them and allows us to buy multifamily at higher cap rates. And we're going to continue to have board members reside in the communities we invest in, be the expert in a kind of a large player in the markets we invest, so we can really think, act, and just plan locally and be smart on where we invest and be well informed. And most importantly, we intend to remain a private REIT. That's an important objective for us.
Love it. I love it. I love the strategies, your area of expertise, the company history, for all you listening, watching, do your due diligence, you can get in touch with Matt and Danelle. Just go to dakotareit.com. You can check it out there, get in contact with them. And if you have additional questions, let's do a little bit of Q&A and then let's bring it home.
Okay.
Shall we?
Yeah, do you have questions for Matt? Well, we got him, and either of I don't know. What do we got?
Yeah, I mean, so typically, really it's just specific to Dakota REIT. Like, what are your average historical returns?
Our average return over our 23-year history is 11.74, assuming you reinvest your dividends.
Yeah,
If
it's
you
right up
did,
here. These will get up on the website. So for those of you that want to crunch the numbers, and I know we talked through this fast. This was the slide on the S&P 500, but these will get up on the website in the next day or two.
And then how often are you paying the dividends?
the dividends are paid quarterly.
There you go. Okay. And then
You can either take it in cash or reinvest it at a 5% discount.
okay. Cool. And then I'll say this, like, on, redemption stuff, because some of you, we're chatting in that, want some clarity on that. Matt outlined that earlier, but it's similar in most, like, even real estate funds. There's like, if you're trying to redeem, prior to the initial agreed upon term or lockup period, like penalties, redemption fees apply. It's no different than what you've explained to us in, a private REIT. That could be, a processing fee or a couple percentage points, correct? Yeah.
It is common for private REITs and private funds. And that's because we try to line up a long-term investment horizon of our shareholders with, our own long-term investment horizon of holding this property, and put some high quality tenants in there with a long-term lease and then a long-term mortgage. It all is all interrelated.
Can you clarify, as you bring on additional shareholders and these different classes that you have, does that dilute the returns?
Well, sort of. It only dilutes it when we're sitting on idle cash, which is never our plan. We always have the ability to bring in $15 to $20 million at a time and deploy it where we're getting an acceptable rate of return. And we don't have share sales occur ahead of where we have a place to deploy it. So lining up capital raise with deployment. So, like, for example, this year, we've acquired almost $90 million worth of property. And there's usually an acquisition on the horizon. I think there's times Danelle and I wish there was a break because it's a lot. But when you line up acquisitions with share sales, there really is no dilution.
Cool. Do you have any other comments, questions?
No, I loved it. I learned a lot. I think private REITs in particular are one. There's just not a lot of great info out there. There's not a lot of good experts talking about it. That's why we felt it'd be great to have Matt come on and talk. And Danelle, Aaron and I have worked with before too on Matt's team. So if you can't get through to him, maybe you're calling with more questions on this. I think Danelle's up to talk to, I believe, Matt.
What's the best way for people to get in touch? Is it just going to dakotareit.com, or what do you want to tell people?
Yep, I think that'd be great. Reach out to dakotareit.com. You can find our contact information there. You can also submit requests online. Maybe, you could say if you wanted to submit a request through our website, you could say that you were attending this podcast with us, and happy to respond to those requests, and really appreciate the opportunity to sit in with you guys and share Dakota Reit's story. So thanks,
Awesome.
man. Thanks, Aaron.
Cool. We really appreciate you taking time to be on and joining us, and we'll say our goodbyes, and until next time.
Sounds good. Thank
All right.
you.
Thanks so much.
Appreciate everyone attending as well.
Okay.
Appreciate it.
All right.
All right, everyone. Well, we just want to there's a little promo here, as we let Matt go. We don't want to, $50 off for any of you to open up a new account. You can use webinar 50. It's in the section 1 on the new account app. And then, did you want to walk through any of this on just opening the account process?
Yeah, we'll just keep it real simple. Just, since we're coming up to the hour mark for time here, it all starts with opening an account. So you got to get a self-directed IRA account open, and we have all the different account types. Again, if you need some help, just go schedule a new account appointment. You can go to our website, directedira.com, click in the upper right-hand corner, and you can just schedule something with one of our senior account reps for 30 minutes, free of charge. And we'll just walk you through any IRA questions, account type questions, etc. The second step is you got to bring money into the account. So typically people do it one of two ways. They either bring it from an old 401k, old employer plan, that would be considered a rollover, and they typically want to send a check over to us, and you have to initiate that request with them. And then
I saw someone ask, wait, what was the webinar code? How do you, it's hard to roll with that, huh? I know.
It is.
Sorry, distracted Aaron.
Or you just do what's called a trustee to trustee transfer. Maybe you have some funds over a brokerage account. Maybe you got a Roth IRA over at TD Ameritrade, and you'll just do a transfer form, and just bring the money from that account over to us, and we'll initiate that request for you. Then after that, you're going to make the investment. The one thing that's cool is, like, when we have like special people that we're working with, special relationships that we already have their investment documents. So we actually have, all the paperwork that we can send to you electronically, that includes their, subscription agreement. For instance, if you're going into a private company, private like Dakota Reit, and we just try and keep it as simple as possible, and we process them quick. I mean, that's really what we're known for. If you go read our 5-star Google reviews, that's what people talk about, how easy it was to open the account, get it funded, and we process the investment quick, because that's really where we get graded on.
Yeah.
It's like, how long does it take? Like some of our competitors, some companies, it takes them like 1, 2, 3 weeks, a month to process a dang investment. And you used to deal with that all the time at the law firm.
Yeah.
Referring clients.
One of the reasons I started this company is I was sick of dealing with all these other companies that weren't very responsive to their customers. They just didn't care. So they were like, I'm like, aren't you on the same team over there? Like, why am I their lawyer having to call and like yell and scream to try and get something done over there because the client needs to fund tomorrow?
Exactly.
And they've been sitting over there for a month. Anyways.
Well, Matt has a lot of experience, and so that's why we have an awesome pricing schedule. You can roll to that slide, and we just keep it real simple. Regardless of how much money is in your account or how many investments you want to make, it doesn't matter. It's just a flat, low annual fee of $295. And every time you go to make an investment, there's just a small one-time asset processing fee, anywhere from $30 to $100 one time. That's it. So how much are you going to get charged each year for an account with us? $295. And what if I have $10 million? $295. What if I want to make 10 investments? $295. So you get the movie there. And so we love it. We encourage you to do that. Just do webinar 50 and get you $50 off. That'll waive the setup fee of the new account. You just pay $295. I think that's it.
Yeah, thanks everyone for tuning in on this. We do these once a month. Make sure you're signed up for the newsletter. You can sign up for that if you aren't already at directedira.com. The full recording of this, if you have to pop in and out, or you're driving in the car or whatever, distracted, you got bored when Aaron was talking, you want, you
That happens.
out.
Just like totally zoned out. You can tell we have fun over here.
Yeah,
we love working.
It doesn't matter who's sitting in the seat next to me. If it's Mark Kohler, if it's Aaron Halderman, I don't care who it is. We're gonna just have a little fun.
It's the hot seat.
It's the hot seat. So thanks everyone, and we'll be back next month. Again, stay in touch with us through the newsletter.
Stay in tune too.
Stay in tune also. Please stay in tune, especially if you're,
We're gonna see some of you live here in a couple weeks at the summit. We just got a few tickets left. So you can go to sdrasummit.com.
Good point.
We do a few of them each year. The next one's coming up in 2 weeks in Scottsdale. So we are doing it live in person. So we hope to see you there, and then we'll do a couple next year as well.
Yeah.
So come see us in person. We'll have a good time.
Yeah, thanks, everyone.
All right.
Stay calm, self-direct on.
Rock and roll.